Oil, the price of oil, falling just below $100 a barrel today in the United States. That reverses its upward moves over uncertainty in Libya previously. Now, the Nasdaq gaining today. The Dow Jones Industrial Average fell. What are investors to do? How do they make sense of all this? My next guest should have some answers, or indeed some pretty good questions. Sam Stovall is the chief investment strategist at Standard & Poor's. He's also the author of The 7 Rules of Wall Street. Sam, it's always good to be with you. Thanks so much for joining us. So what do we make of all this, right? I mean, investors every day, they get buffeted by headlines, by news about companies, by issues having to do with geopolitical risk. What's a regular investor to do?
Well, I think basically you listen to what the news is, but you really don't panic by it. You don't really respond too quickly to it. It really just depends on your framework. Are you a short-term trader? That's not my area of expertise.
Well, let's talk about a little bit long-term. Let's talk about people that are putting away some money and they want to make some decent profits, and they understand that there are going to be bumps along the way and that there might be, drops. But what are they supposed to do if they're looking out on a time horizon that at least lasts a year?
I think that basically they ignore this kind of situation. Certainly they pay attention to it because it could morph into something a lot larger.
And the situation we're talking about has to do with unrest in the Middle East, Egypt, Tunisia, and now Libya. Exactly.
I mean, right now we're going through an awful lot of uncertainty. We really don't know how everything is going to play out. We don't know whether the vacuum that will be established once Muammar Gaddafi is gone from Libya, whether that will end up being favorable to the U.S. or unfavorable.
I feel like I'm channeling Don Rumsfeld, the unknown unknowns, right? These are the things we just don't know about.
We just don't know about, and as a result, you're probably better off not trying to shoot where the rabbit was. What I like to do is remind investors that basically anything that is a decline of 0 to 5% is noise. It happens basically all the time. You need this in order to allow for the digestion of recent gains, etc. Even when you look to what I call pullbacks, declines of 5 to 10%, we've had 53 of them since World War II. They recover everything they lost in an average of only 1 month. We've had 18 corrections of 10 to 20%. They've recovered everything in only 4 months. So really, by the time you have repositioned your portfolio, the market is probably well on its way to recovering all that it lost.
All right, so tell me about the mixture that exists on Wall Street right now. You've got pretty low interest rates. You've got everybody reporting more or less the fourth quarter results, looking into 2011. How do you put corporate profits together with interest rates, with oil, with commodities? What kind of program do you have for the next 12 months?
Well, I think that's what makes me feel a little bit sanguine, positive, despite the negative news that's going on right now, is that when you look longer term, things still look pretty good. We're calling this a half-speed recovery, but it seems like the economy is picking up speed, not only here in the U.S., but also around the globe.
Right. The initial jobless claims today, the report under 400,000. There was a drop of about 22,000.
Mm-hmm. And I think from a corporate earnings perspective, sure, we had a bang-up year in 2010, up 47% year over year. We think we're going to see a 15% increase, bringing us to $96 for the S&P 500. If you applied a fairly reasonable PE of 15 times, that would say that the market could go to $14.25 on the S&P 500. Also, even though we are looking at the possibility of higher interest rates, not necessarily from the Fed, we think that would happen maybe later this year, early in 2012, the market might be pushing up interest rates. In that case, you focus on companies that have relatively low debt-to-equity ratios because you're not going to have an impact in terms of interest expense when they roll over that debt.
Are there specific companies or specific industry groups that you're suggesting people pay particular attention to?
Yes. I did a screen on our MarketScope Advisor service, basically pulled up those companies by sector and said, well, what's the median debt-to-equity ratio per sector? And I found that information technology has the lowest debt-to-equity ratio, probably no surprise. Their margins are so wide, they really don't need to borrow in order to continue operations. Healthcare was actually relatively low, as was energy. So if you wanted to focus on companies that also had low debt-to-equity ratios but favorable investment outlooks by S&P analysts, you'd look to companies like EMC in the technology space.
A big storage company storing data.
Exactly. In energy, well, it's the names you've been hearing the last couple of days, Exxon and Chevron. You could also take a look at Thermo Fisher Scientific in healthcare. Even Coach, the handbag company, has a fairly low debt-to-equity ratio. And if you wanted to stay cyclical in that that regard, then Coach is one of the good ones.
All right, we're going to leave it there, but I want to thank you very much, Sam Stovall from Standard & Poor's, sharing your insights. Pay attention to Coach, Thermo Fisher King, as well as companies like in the energy services business, and indeed EMC, that's talking about information technology. Always a pleasure to have you.
Pimm.
Thanks for your insight.